This could be a major turning point for this stock, and I truly believe that over the next few weeks or months, we're going to witness a completely different side of it. And that stock is none other than UNH, United Health Group, the biggest health insurer in the US. Before we dive into this video, I wanted to say thank you. The support on the last video has been overwhelming. We've passed 5,000 viewers. You all seem to love the analysis. So today I'm back with a deeper dive covering 5 things. Firstly, the current business model and leadership. Secondly, the company's current weaknesses and strengths. Thirdly, what to expect from the upcoming earnings and 2025 outlook, a full intrinsic value breakdown, and finally, I'm going to talk about whether I'm buying or not. So earlier this week, UNH dropped below $300 again, hitting the 299 mark for the second time this year. And I honestly feels like everyone's running away. Investors' sentiment is at the rock bottom, but for me, this looks more and more like a no-brainer opportunity. And let's take a step back together. Let's go back in history and let's hear a story about someone we all admire, Warren Buffett. Warren Buffett has spent decades reminding investors that sometimes bad news is often the best opportunity to buy a stock. And we all know his number one rule, which is never lose money. We also know his number two rule, which is never forget rule number one. So in the 1980s, Buffett bought into a company that had just botched a massive product change. They had a new formula which was rejected and the stock price crashed. But Buffett saw value when everyone else panicked, when everyone else was selling, and he invested in the stock. Now, since then, the stock appreciated by more than 70 times. What stock do you guys think this is? Well, dun dun dun. Well, it's the one and only Coca-Cola. And, Coca-Cola firstly failed to attempt to replace its original formula with a new sweeter version in 1985. They were struggling at the time with competition, losing market share from Pepsi. They wanted to do something different, and they had positive results from their blind taste tests. But when they actually went to market, consumers really rejected their new formula. Investors lost confidence, the stock plummeted, and in the combination with the stock market crash in 1987, Warren Buffett bought heavily. And why it matters is because it really reminds me of a stock, UNH. Yes, UNH, they have made mistakes over the last 1 2 years, and we're not gonna hide behind our finger and say they haven't. But at the end of the day, the fundamentals are still very strong, despite of all the noise, all the negativity. The fundamentals are sound. The company is a vertically integrated, diversified giant, and it's not like a speculative name like other tech companies. It's a 400 billion revenue powerhouse, and it's operating in a growing market as healthcare demand rises with aging population. It actually The market itself is expected to grow 6.6% a year until 2030. So this is a business to last. This is a business with leading margins, with massive moat with their Optum business and insane integration. So yes, let's not deny it. As I said, the short-term problems exist, and it's the reason why we're here and we're talking about it. But at what point does the valuation get too hard to ignore? We do have the Medicare Advantage concerns. We do have the claim cost pressures due to their failed pricing strategies. We do have the regulatory noise. And one thing to note is that because has the biggest market share in the US healthcare industry, is the first in line when uncertainty strikes. When there is regulation concerns, when there is any sort of backlash for the industry, UNH will be the first to be hit. But here's the thing, at 14 times forward earnings, the stock is priced like a slow growth utility, and it's a compounder, a company that grows revenue more than 10% annually. It's still a very high quality compounder. And so for us is whether or not the valuation is just too hard to ignore at this point. So before we actually dive into the financials themselves, I want to explain the segments that UNH makes money. And there are two main segments. Firstly is the United Healthcare, which is the core insurance business. They collect premiums, they pay out claims, they earn profit on the spread. And secondly is the Optum bucket, which includes Optum RX, Health, and Insights. And just to summarize, so RX manages prescriptions, Optum Health delivers healthcare, value based care service contracts, and Optum Insight sells healthcare software and consulting, and it has the best database in the market. Now, as I said, United Healthcare is their largest, their core business, but they are a very diversified company. Also, just to break it down in terms of how they bring revenue into the company, each segment operates with slightly different business model, but it's mostly fee based, which means it's predictable, it's recurring, and it's high margin. Especially some of their businesses like Insights, which is growing at double or triple the rate than the rest of the product lines. It's a very high margin business, and UNH is positioned in a way where, firstly, is the biggest insurer in the US. They have 26% market share. Secondly, Optum, especially Optum Insight, has the best healthcare data in the US. It's growing at double digits. And also, it shows how the company has an insane vertical integration. They operate in the industry end to end, which allows them to have the best margins, the best pricing strategy, and the best positioning in the market. Now let's talk leadership and take a look at this insider buying chart. See that green over here? This is where the drop came in and we were looking at 300 price per share. This is when we had the biggest wave of insider buying in the last 2 years. And here's the most interesting part. The new CEO, Stephen Helmsley, bought 25 million worth of stock in Maine. He wasn't the only director, by the way, to buy stock. And this was only just weeks after taking the role. Now, this kind of move might seem like a gamble, but at first glance, this isn't. And I'm going to tell you why. Stephen has led UNH between 2006 and 2017. During his tenure, the stock went 7 to 8 times in value, and he's one of the CEOs that is known for driving operational efficiency, expanding through Optum, and turning UNH into a dominant force. And guess what? Operational efficiency is exactly what UNH needs right now. So Steven left with a track record and he's back to change things around. And the fact that he's investing 25 million just weeks after taking the role shows confidence in the business, so shows confidence in himself. And that's exactly what I look for when I invest in a company. Now let's look at some numbers before we dive into the intrinsic value analysis and what I'm looking for next. So UNH has been consistently increasing its dividend for the last decade or so, and today their dividend yield sits at almost 3%, which for me is extremely insane, with buybacks included. So this is the buyback yield. So how much stocks the company is buying on a year-by-year basis, which increases our shareholder yield. That takes our shareholder yield to 3.5%. But I want you to imagine this. If UNH maintains the pace dividend growth and buybacks by 2030, if you invest right now, your shareholder yield will reach 5 to 6% by 2030. This is on par with the world's best rates without fees plus capital appreciation. So it's very rare to find this combo in a mega cap healthcare stock. And it's actually one of the reasons why I started looking at the stock, because I thought that not only this is a compounding, everything could go wrong. Maybe the company doesn't grow at the size we expect it to, but the dividend yield, it's so attractive. And especially with the track record of growing that yield, it will get to a point as a value investor, as a long-term investor, where I'll be getting 5 to 6% in 5 years from this stock, which is very, very rare. Now, from what I'm watching now is, first of all, I'm watching for, I'm looking for the second quarter 2025 earnings. I'm looking closely. Investors are desperate for a positive surprise, and expectations have been priced so low that even a small bit could turn sentiment, in my opinion. I built a financial model that takes into consideration a drastic drop in EPS. So as you can see here on the bottom right chart, I have estimated an EPS of $20 per share, which is what analysts expect, which is why you see a drop for 2025 in net income, with really what I call base case assumptions. So revenue growth, EPS, and FCF growth lower than what the historical growth has been. We see an intrinsic value using a DCF model of just 11% below what the current price is, and an intrinsic value using the EPS method of 13% higher of what the current price is. So overall, from here downwards, the price is insanely attractive. And again, I've put in what analysts expect to be, a disastrous year for 2025. And slowly the company gets back to what the net income has been in 2027 or 2028 onwards. So even with that being priced in, we still see that the company is still undervalued today. So in terms of final thoughts, regardless of what Q2 2025 brings, I do think that things will get worse before they get better. I do expect the company to suffer short term, but I'm a long term investor. So when I think about long term, I do believe that the company will turn things around. And for me, the price target for 2026, and the reason why I use 2026 is no one knows where the company will be by end of 2025. I mean, they're currently still trying to sort their problems out, but I do think by 2026 we'll see a company that is close or even above what they were before. So, for me, anything below 290, I'm probably buying. And with that being said, I wanted to thank you for watching. Leave any questions below and I'll sure answer them either in the comment section or next time. Please subscribe. It helps massively if you subscribe, and I'll keep posting more videos about UNH if you want to. Thank you so much.